Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Energy efficiency and smart home integration drive today's lighting market. We've seen a massive shift away from old technologies and toward light-emitting diodes or LEDs. This change affects utility companies, real estate, and especially the stock market. While LEDs dominate, many companies hold on to older, non-LED lighting production. This typically includes older fluorescent technologies or traditional incandescent bulb lines. Investing in companies focused on outdated lighting often means holding a depreciating asset. For investors, this will be a critical year. Companies that haven't transitioned fully to modern lighting solutions face serious financial challenges. We'll show you the specific red flags and business models that make certain non-LED companies risky investments right now. Protect your capital by recognizing these outdated players before it's too late. The inevitable decline. Why old lighting tech is a risky bet. Holding on to traditional lighting products is like trying to sell cassette players in the age of streaming. The problems are not just about mild inconvenience or slightly higher costs. They are structural issues that threaten the long-term viability of any company relying on this outdated technology. We are seeing a fundamental market shift driven by law, efficiency needs, and changing consumer desires. For investors, placing bets on companies that ignore this reality is a move towards certain disappointment, as the products they sell are rapidly approaching obsolescence. Government regulations tightening the noose on inefficient bulbs. Global energy policies are no longer tolerating waste. Governments worldwide, particularly in major economic markets, are actively pushing less efficient lighting systems out of the market. This creates a harsh reality for lighting companies that rely heavily on older stock. When a major sales category is legally banned, the impact on revenue is immediate and devastating. A key focus of these regulations is efficiency ratings, measured in lumens per watt. LEDs commonly deliver 80 to over 100 lumens per watt. By contrast, traditional incandescent bulbs struggle to reach 15 lumens per watt. These low-efficiency numbers mean higher operational costs for everyone involved, from the manufacturer to the end user. Consider the phased removal of traditional incandescent and halogen bulbs across the United States and the European Union. The Department of Energy finalized rules requiring bulbs to meet a minimum 45 lumens per watt standard. This benchmark effectively eliminates almost all traditional inefficient bulbs from production and sale. The European Union has moved aggressively to ban most non-LED directional and non-directional lamps, accelerating the market's transition to ultra-efficient alternatives. These regulatory environments create immediate risk. Companies that maintain huge inventories or production lines for non-compliant bulbs must liquidate them quickly or face unusable stock. This sudden regulatory pressure forces lower margins and decreases long-term sales potential, making these businesses inherently unstable. Consumers choosing smart and efficient lighting first. The modern consumer judges lighting based on three essential factors: longevity, efficiency, and functionality. Older lighting technologies fail these tests spectacularly, which directly impacts the purchasing decisions of both residential and commercial buyers. People no longer simply want a bulb that lights up, they want a sophisticated system. Consumer behavior has shifted dramatically over the last decade. Focus on lifespan. LEDs last 15,000 to 25,000 hours or more. Traditional bulbs require frequent replacement. Consumers understand that time spent changing bulbs, especially in hard-to-reach commercial fixtures, costs money. They opt for the set-it-and-forget-it reliability of LED technology. Lower operating costs. While an LED bulb costs more initially, the sheer reduction in electricity bills makes the return on investment quick. Buyers are now educated on the massive energy savings offered by LEDs, often using online calculators to compare utility costs accurately. Advanced features. Older technology cannot compete with the features consumers now expect. They want the ability to adjust color temperature, use precise dimming controls without flicker, or integrate bulbs into a smart home system like Google Home or Amazon Alexa. For example, Incandescent bulbs dim poorly, and fluorescents are notoriously difficult to control precisely. This product gap makes non-LED options instantly obsolete for many new constructions or upgrades. Stagnant research and development budgets telling a clear story. A company's investment strategy speaks volumes about its future prospects. When a traditional lighting manufacturer shows consistently low or decreasing research and development budgets for solid-state lighting, that is a massive red flag. This indicates a management team prioritizing short-term profits from legacy products over long-term market sustainability. Leading lighting companies view research and development as an essential investment in new LED materials, miniaturization, and smart control systems. They are focused on generating new patents and refining efficiency. In stark contrast, companies stuck in older technologies often see research and development on new products as an unnecessary expense because they are trying to protect aging margins on existing halogen or fluorescent lines. This lack of investment creates a severe product gap. Market leaders roll out smaller, more efficient and connected LED solutions yearly. Companies focused on old tech only slightly modify existing bulb designs or simply maintain production. By starving new technology development, these firms miss out on crucial business sectors like high-end commercial fixtures, specialized industrial lighting, and the burgeoning smart home market. When the regulatory axe falls or consumer demand fully shifts, these companies have no sustainable, high-margin products ready to replace their lost revenue streams. Their inability to invent their future makes their stock highly speculative and dangerous. Financial warning signs, identifying companies stuck in the past. Looking beyond press releases and marketing hype, every investor must study the financial health of a company. When traditional lighting manufacturers struggle to adapt, the stress shows up clearly in their financial reports. We look for specific metrics that scream systemic risk when assessing companies that rely too heavily on older lighting products. If a company exhibits these signs, their ability to survive the market shift is highly questionable. Revenue dependency on declining product lines. How do you know if a company is truly moving forward or just pretending? You trace their sales back to the source. A primary red flag is a high percentage of sales derived from legacy products like halogen, core fluorescent tubes, or standard incandescent bulbs. These product lines are low margin, legislatively challenged, and rapidly losing market share to superior LED alternatives. To check this, examine the Notes to Financial Statements section of the company's annual report or quarterly report. Companies must often break down revenue by product category or segment. What to look for in financial reports. If the company still lists traditional lamps or legacy lighting as a significant revenue segment, note its percentage against total sales. Anything over 30% dependency on these traditional lines is a huge concern. LEDs are generally higher margin products than fluorescent tubes. Look at the gross margin trend. If the gross margin is decreasing even as LED sales rise, it might mean the company is heavily discounting old stock just to clear warehouse space. A sharp drop in the revenue from a legacy segment, even if the volume remains relatively stable, indicates brutal price competition and shrinking profitability in non-LED markets. This is a clear sign that the product line is unsustainable. When revenue is tied to outdated materials, the stock faces a huge valuation haircut. These companies face real challenges in adapting to modern lighting trends. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.